Okay, well, we might as well get started. Okay, so we're already in our third week. Any questions by Mary or Terry? Any questions out there?
No questions.
Tremendous. All right, and so far, people's work, I'm really pleased. And I haven't seen anything that it doesn't look really good. You guys are doing great. All right, so let's look at the week 3 work now. I set it up. I kind of like compiled everything here. I've already sent out a number of announcements. So by the end of this, you want to look at how to value a capital project, right? Do we want to abandon it, expand it, or postpone it? We want to look at the shareholders' interest and required rate of return, right? So what's the rate of return? It would be the combined cost of equity and debt, right? There's only two ways, as we've been talking about, that you could fund the project. It's either by selling shares of the company, which is equity, or by borrowing money, which is debt. We evaluate the role of an organization's debt ratios, right? This is all about capital budgeting. And what capital budgeting basically is how does a company, or even a human being, even an individual, how does an individual or a company arrange their finances in order to have the optimal capital budget? So I'm borrowing money or I'm selling shares. Now, what do you suppose is the better thing here? Borrowing money or selling shares? It depends. It depends. It depends. Now, theoretically, borrowing money would always be an advantage because you get a tax deduction. A company gets a tax deduction for borrowing money. And if you want to go into capital market theory, and I think I have something here for you guys. Well, let me share my screen. Did not do that. Stay with me. Okay, so I'm sharing my screen now. So why do you suppose, right? So what capital budgeting basically is the choice between equity or debt. And some of the original thoughts on capital budgeting were done in 1958 by Medigliani and Miller. And these guys are like on the Mount Rushmore of, they're on the Mount Rushmore of financial theory. So when we talk about the Medigliani-Miller theorems, let me see if I can find it here. We talk about different assumptions, but what Medigliani and Miller said was a company really doesn't matter. It really doesn't matter how a company finances itself. It's all dependent on cash flows because the capital structure is irrelevant to the value of the firm, is what Medigliani Miller says. And why do they say that? Because they say even if you bought a company that had leverage, or if you have two companies, one company that has leverage in it by borrowing money, and one company that doesn't have leverage, a shareholder could buy the company without the leverage and add their own leverage to it. They can go out and borrow the money, right? Think about it. If I have a company with 30% of debt and I have another company, equal companies, that one thing about the Medigliani-Miller theorem, because it was like the first theorem, is that they make a number of assumptions, obviously. You have to make assumptions, right? That the capital markets don't have friction. Now this, by the way, a lot of this stuff is all contained. I want to go back to here in the text in chapters 10, 11, 13, and 15. You get a lot of this stuff right here. 10, 11, 13, and 15. Okay, so just so you know where to look, because that's part of what you need to do this week is read that, right? You got to read that. So going back to Medigliani and Miller, they make a number of assumptions. First, they say there's no friction in the capital markets. So right off the bat, they assume there's no commission costs. There's no bid-ask spread, right? You don't have to pay to buy or sell stocks. But we know that capital markets do have friction, and they add to the cost. Even if a company wants to borrow money, they have to go through an investment bank, and they have to pay an investment bank a commission. Another assumption they make is that individuals can borrow and lend at the risk-free rate. And we know that that doesn't hold true, right? You have to pay more than the risk-free rate, right? There's more than that goes to work. Here's a big one, that there's no business disruption cost. There's no bankruptcy cost. We know in further views of this theorem, right? The original theorem said it doesn't matter. If I have a company that has no debt, or I have a company that has debt, let's say company A has 30% debt and company B has no debt, I could buy either company. I could buy company A and own 30%, and they're equal companies. Everything is equal. I could buy company A for 30% debt, or I can buy company B with 70% of my money and borrow 30%. Either way, I've created my own debt. So really what M&M says, if you believe all these restrictions, or you assume all these restrictions, well, then you can create your own debt. But so here, but we find later that is more favorable to equity, because you get the tax deduction. How does that work? Well, if I borrow money at 5%, and I could write it off of my, let me call up an Excel spreadsheet. So if I have debt on my balance sheet, it's like a mortgage, right? You get the deduction on your mortgage. Well, the same thing happens in corporate debt. If a company goes out and has, and I'm going to make this very simple, has $100,000 of earnings and is in the 30% tax bracket, right? In the 30% tax bracket, okay? Well, if I have no debt and I just have to pay taxes, this is the end, this is the final number I come out with, my taxable income, I'm paying $30,000 in taxes. Company B has used 15,000 of debt, so it's 100,000, right, of earnings. But now I can deduct 15,000 of them of my debt before I have to pay my taxes. So I'm going to put in a minus 15,000. Sorry. Oh, let me make this bigger so you guys can see it. So I'm going to put in a minus 15,000, and I'm going to sum that. And notice that my taxable income now has dropped to 85,000. And if I apply the 30% ratio, which obviously taxes change at different levels of income, but I'm going to assume it's the same just for the sake of completeness, times 85,000, I'm going to come up with 25,500. Notice the difference in the taxes I owe is $4,500, which is basically the difference between 30 and 25,500. So I've saved 4,500, or 30% of my debt. So the government effectively picks up 30% of your debt, which makes debt cheaper. So one of the restrictions that Medigliani and Miller says, well, capital structures are relevant. But in later pieces by Miller himself, they say, well, no, debt has a value. Debt has the tax shield. And so when you do the weighted average cost of capital, you have to take the cost of equity plus the debt cost of, the percentage of debt minus the tax shield. So if your cost of equity is, say, 10%, and your cost of debt is 10%, right? That's equity, that's debt. You would assume that if I have a 50-50 split between debt and equity, and generally speaking, in most cases, it's 70-30, 85-25. Those are the numbers you generally see. But let's say 50-50, then you would assume that, well, my cost of my cost of capital for my firm, my weighted average cost of capital, is going to be 10%. But remember, you get this deduction. So if you're in the 30% tax bracket, you're only effectively paying 7% on debt. And if you're a 50-50, then it's 5. 50% of 10 is 5. 50% of 7 is 3.5. You've effectively reduced it to 8.5. Any questions on that? This is really important you understand that. Any questions? Any questions?
No questions.
Okay, so if there are no questions, so now you understand the cost of debt. But then later work, and this is Medigliani Miller, they call it Proposition 2. Proposition 1 said doesn't matter. Proposition 2 now starts to entertain the idea of debt. And without taxes, they say, well, debt is still favorable for a variety of reasons, but that if I put on more debt, the market's going to demand a higher rate of return on their equity because they're going to think that I'm putting on debt. And then I'm going to have business disruption costs, which is the risk of going out of business, the risk that I might not put on new projects because I have debt, the risk I might not do new things, the risk that I might be preoccupied effectively with the debt. Once I introduce the tax shield, the tax benefit, well, then debt is clearly favorable to equity, right? That is clearly favorable to equity. But there are benefits to selling equity, right? The people who own the equity get benefits. The people who have equity, your buyers, your investors, they have capital gains treatment. They can hold on to equity for a long time and get a lower capital gains treatment, even though now the latest tax budget might be raising capital gains taxes. But they still have that ability. They don't have to sell, and they could put that stock into a retirement plan or tax advantage plan and let it grow tax free. So there are benefits to equity that the investors get that balance out what's going on with the company. But remember this, that as I start using more debt, even though debt is favorable, my cost of equity goes up because people worry that I'm taking on too much debt. But then as a flip side, they also get benefits from equity. So there is a balance, there's an equilibrium between this debt equity mix. And once I can come up with the balance of it, then I have my cost of capital, and I can discount my cash flows based on that cost of capital. Okay, so going back to my sheet, no bankruptcy costs. So you see what Medigliani Miller had to do. They say no friction, no bankruptcy costs. They only issue risk-free debt and risky equity. That doesn't exist. We know that that is risky, right? High debt ratios cause business disruption costs. Short-term debt and variable debt lowers costs. There's ways to lower it by taking on shorter debt. We don't count the current assets, the current liabilities, like accounts payable, accounts receivable, because we assume that's in our cash flow. We really look at the more longer term debt. All firms are assumed in the same risk class, right? I can't say that company A who has leverage is the same as company B if they're not in the same risk class. And I have to assume that there's no corporate taxes. There are also other taxes, right? There are also other taxes. No agency issues. What does that mean? Well, in the real world, there are agency issues. In the real world, if a company or symmetric information, that means that the managers of a company might have information and possess information that the investors or the lenders don't have. In which case, they may arrange their debt equity ratios in ways that benefit them, but don't necessarily benefit the stock or the shareholders. So say, for instance, they own equity, right? And equity is sort of a call option on the firm, right? Because I can keep piling on debt, taking on more risk, and it pays for me to have more risk because now I own equity. If for my equity to make money, I want to see the stock either shoot up and I'll take the risk of it going down. That would be an agency problem. That would be an agency problem. The other agency problem is managers might take perks, right? They might take things like planes or big benefits, and they may not do the work, or they may be worried about taking on new projects, so they may not even want to put the time in to look at new projects because most of their compensation is coming in from selling off parts of the firm and taking in some of their perquisites, right? Some of their benefits that make their life better, but not necessarily investors' life. So what we're really saying is the cash flows from a company are not independent of the ownership structure, and that it's not realistic to think that that the investors and management have the same information. So, for instance, we have pecking order theory, right? What's pecking order theory? Where we say that a company would rather not sell equity because they have to take in partners. If they sell equity, they may be signaling to the markets that their projects aren't that good and they want other partners. Think about it. If you're a manager, you're going to, and you know the projects are good, and you have a lot more information than the investors have, you're going to be reluctant to give away more partnership interests or shares. But you may want to then, it's more profitable to take on debt. So you may pass on some things where equity might be beneficial. You may pass on some things where issuing debt might be beneficial because you don't want to send out negative signals and hurt your share price. In which case the company suffers because you're not taking on projects, because you're more worried about it. What we know with pecking order is we'd rather have retained earnings because retained earnings doesn't send out any signal And it also makes sure that the company has enough income coming in that they can invest in positive net present value projects. So if a project comes in that makes sense, they don't have to do this dance where they're worried about, should I issue equity? Well, if I issue equity, it's going to hurt my stock price. Should I issue debt? Well, that's good, but people might knock down my stock price because they're worried that I'm taking on too much debt. By having financial slack or retained earnings, that would also make it more palatable for management to be investing. And then finally, cash flows are in perpetuity and all projects have similar expectations. I have to assume these things if I'm going to assume that, capital structure has no relevance. I have to assume these things. I'm going to assume that capital structure has no relevance. So that's really like a good overview of capital structure and why I need to understand how important it is about capital structure, because I want to know that if I have the right mix of equity and debt, I'm giving my company the best possible, the lowest rate of return, and giving my company the best possible rate of return for investing in projects. In other words, if my cost of capital is minimized and it's the correct use of capital, I don't run into any of these agency costs. I don't run into any of these signaling costs, and I've put together the optimal equilibrium cost of capital. And when I discount my cash flows, I can justify the best deals possible for my company, right? Because we know that net present value comes into play, right? So if I have a company that, if I'm looking at a project that generates $1,000 over 3 years, and my weighted average cost of capital, because I'm passing on using some equity, I'm not using the optimal amounts of debt, is 10%. But now if I have retained earnings, and my retained earnings are funding things, and I'm not worried about signaling, and I'm not worried about the market perceiving that I'm putting on too much debt, and I'm not worried about any of those things, I can borrow, like my weighted average between 10 and equity is 7%. Well, watch what happens. How do I value a company? How do I value any firm? I'm going to do it this way. Go to formulas, you go to net present value, and here in project A, my rate is 10%, and my value is $1,000. So the project is, when I discount these cash flows by 10%, I got a project that's worth $24.86. But if I do it here, all you got to do is go to formulas and then go to recently used and go to NPV. Now the rate, I'm going to use the lower rate, and by just understanding time value of money, right, I'm sorry. I'm going to use the lower rate, and just by understanding the time value of money, the project is worth more to me. I could justify a higher rate. I could better justify this project. And if and depending on what my hurdle rate is, or what projects I will accept, I'll accept more projects with a lower discounted rate. Obviously, there are other things that can affect my discounted rate: the markets, inflation, the cost of equity at any given point in time, the prevailing price earnings ratios. But then there are going to be the things that are indigenous to my company and the decisions I make. So this is kind of an overview of capital structure. Going back to my notes. So your first project is, based on the information you learned about capital structure, budgeting, determine what optimal capital structure should be for Gentry. You'll need to determine how much equity, common stock will be offered in the IPO, and how much debt the company should assume to meet the goal of 50 million. So really, you're going to do a 500-word APA formatted paper. You're going to determine what capital structure will work best for your investment. Use ratios, include the dollar amount of equity the company should issue in the IPO, and how much debt the company should use. So there's no single answer. Your assessment is weighed more heavily toward a logical explanation. So based on what I've just given you, right? And then this is how you have to put the file extension. Based on what I just gave you, you could use these theories to start putting together an idea of how you want the capital structure to work, right? Bear with me. Is the text. Right? And if you go to capital budgeting, well, it starts at chapter 10, right? So go to part 2, chapter 10. First, you're going to want to talk about stock valuation, right? How do I value stocks? I already put down, go to my YouTube channel. I have a bunch of videos. That's the key word this week. YouTube. YouTube is the key word. So I want you to go to my YouTube channel. So we'll go here. And we'll go to playlists. And we'll go to Finance Academy. And all the stuff they talk about in the book is here. These are equity value models. So you could use the equity value model to see all the different equity value models I go over that are covered in the book. There's time value of money in Excel. I've included these links so you can go right to my YouTube channel. Here is calculating beta, which you don't have to get into right now. Here's how to find a corporate bond yield, which that's how you have to know what you're paying for debt. Part of it is what are the markets charging you. Later, we're going to go over another assignment you have this week on ratio analysis. There's a video on that, ratio analysis. Here's the capital asset pricing model, which is another model we use to value equity. So yeah, here's the Gordon growth discount, dividend discount model, which is again is another way for us to value equity. And then we have my accounting playlist that I included in my accounting spreadsheet, which gives you the introduction and lets you go over, teaches you how to go over the financial statements of the firm. So you have a lot of stuff here. A lot of good stuff here. Please use it to help you get the right answer, right? I even have a thing on weighted average cost of capital. Got a lot of stuff here that could help you with these projects. Okay, going back. So you're going to put this project together on Gentry. You're going to talk a little bit about the things I covered today, and you're going to have to look in the text and maybe borrow some stuff from there. So that, so we make sure that you really understood what you were looking at. We talk about the risk reward trade-off, cash flows are a source of value. Do we use common with stock or debt? This is all chapter 10. They talk about characteristics of common stocks. There's your thing on IPOs. An IPO is when the company first offers the shares to the public. That's when they take the money in. They don't take the money in when the stock trades, because that's just the stock being traded from one investor to another. So remember that. The stock market is not the IPO market. When a company issues an IPO, then stock issues an IPO, they take the capital in at that point. Afterwards, the stock trades, that's just a function of liquidity. People trying to buy and sell the stock. That's all that's happening at that point. Common stockholders have a claim on income, because they're partners, and they have the right to the residual income after they pay off their debt. So that's why we tend to look at debt. We tend to look at debt as a option on the company. I'm sorry, we tend to look at equity as an option on the company. Why is that? Because if I have equity, I can keep putting on debt, making the company more leveraged, right? That means the potential for profit is greater. But if I lose, the biggest losers are going to be the debt holders because they put the money up. So effectively, I've created a call option, right? Think about it. If I have $1 million of income or zero, the 50-50 probability of how my year could go, and all I have is equity, well, I got a 50-50 chance to make, say, $500,000, right? 50% of $1 million and 50% of zero is going to be $500,000. I could do use a spreadsheet, but I'm just gonna type it in just for the sake of completeness. But if I put debt on this company, say to the tune of, instead of having $1 million of equity, I have 500,000 in equity. And 500,000 of debt. Well, let's watch what happens. Now, in the first case, I had $1 million of equity. My potential is either a 0 or $1 million. So my average rate of return is going to be 500,000. My average rate of return. 500,000 divided by my $1 million of equity is going to be a potential profit of 0.5 or 50%. But now in part B, I have 500 and 500 in debt. And in the same cash flow scenario, which is I could make up to 500,000. Well, first I have to pay off my debt. So say I'm borrowing money at 10%, right? In either case, I'm going to have to put up minus 10,000, minus 10,000. So my potential is going to be, this will be 0 no matter what, because now I have no money. I'm bankrupt. And the bondholders are going to take the first 500,000 hit. And my good scenario is going to be 490. Right? I could just subtract, but I didn't do it. So now my profit, my potential profit, is going to be 102%. So notice I've leveraged my investment by putting on debt. And the losers will be, I have the same scenario, the losers will be the debt, first 500,000 of debt holders. So it would pay for me to put on debt because effectively I've created leverage and I've created an option on the company. So that's when we say equity has claims on income, debt does not. That's just entitled to their payout. One mistake I made here. If I'm borrowing 500,000, then that number should have been minus 50,000. Right, 10% of 500 is 50. So I made a little error there. Let's just do this the right way. That's sum, because I'm going to teach you something, of this plus K10, 450,000. So I can make $450,000 profit on a $500,000 investment. 90%. So you see how I've levered my investment and it gives me a greater potential for profit. So therefore I'm going to want more volatility and I'm going to want a bigger swing. Because if I lose, I'm going to lose anyway. So I might as well lose big and win big than lose small and win small. Because now I have the debt holders that are going to bear the first 500,000 of the burden, and I can make money on the rest of it. So you get an idea of how that works. Okay. Any questions on that? Any questions? Any questions? Guys out there? Okay, good. No questions. All right. So talked about that. We talked about that having voting rights. Say equity has voting rights. And then we talked about agency costs. Common shareholders elect the company's board of directors, and the board of directors pick a management team. As a result, shareholders effectively control the firm. In reality, the system frequently works the other way around. Shareholders are offered a slate of nominees, and they effectively just choose whatever board they're given. And this could create agency problems. And agency problems don't necessarily owe their loyalty to firm stockholders if their incentives are not properly aligned. They may put their personal interests ahead of those of the firm's owners. This is referred to as an agency problem, and it's one of the big problems when we talk about capital structure and about how to run a firm. These are run by professional managers on only a small percentage of the firm's shares. So when this is the case, they're likely to avoid unpleasant tasks, such as reducing the number of employees. They may take less profitable projects that they personally like while avoiding the risky projects that may jeopardize their jobs. Now, we just talked about them taking on projects that have more variance because they have an option on the stock. Right? They may take on projects that don't necessarily, in the case of our little example here, the better project might be a project with less variance. That would be more safe. That may not be a zero or a profit. The better project might be something that might be like you only make 10% or lose 10%. That may be safer for every party involved, including the debt holders. These investors may not, these managers might take the more risky idea to benefit themselves. They also may not take any risk at all because they're getting a lot of perks. There's a lot of ways to look at this, depending on who the managers are and what their deal is. But generally speaking, in a large corporation, a manager can only own so many shares, right? I mean, that's going to make such a big difference. Studies have shown that they get pennies on the dollar, very like fractions of pennies on additional earnings. So they may look for other ways to benefit themselves. That's an agency problem. Because think about it, a company like IBM, how much could the owner own? Maybe a little tiny amount. It's a lot of money, but it's not a lot of money in the idea. And they may own like $30 or $40 million of IBM stock, but IBM is a billions and billions of dollar company. So they even though they may take on, they may avoid risky projects, they may take on risky projects, they may not want to fire people, they may do things to protect their position. And they're difficult to quantify. Occasionally you see indirect evidence of importance. For investors feel that management of the firm has been damaging shareholder value. One way that they can do it is they can either bring in their own slate, which is very hard to do. You have to kind of challenge the board, and you got to get the votes and get out to the shareholders. And remember, most of these shareholders have small amounts of stock, or they have it in a retirement account. They don't have a vested interest in putting a lot of time into looking at this deal. That's one issue. The second issue is, that's why the government or the markets kind of encourage takeovers, because takeovers will force out companies that aren't being run efficiently, right? Then they have to be afraid that someone's going to take them over. So the whole idea of the takeover has helped them. Has helped the markets get rid of the agency cost. Okay. We talked the dividend discount model as we're discounting the dividends. In this case, I'm not going to go over it. I want you to refer to my YouTube on dividend discount model. Okay, I want you to refer to my YouTube right here. You can find it here on the equity value models. You can also find it here on the Gordon dividend discount model. That's another way that's one way you can value the firm. But if a firm doesn't have dividends, you have to kind of assume it by their cash flow, what their dividends would be, or we use the traditional capital asset pricing. Okay. Keyword is YouTube. All right, so we can do the basic dividend discount, which is dividing the discount. If there's a growth rate, we would reduce our cost of capital by the growth rate. So for instance, if a company paid a $5 dividend and the company's required rate of return is 10%, I would put 0.10 in. And the value of the company is the $5 dividend divided by, company's value is the $5 dividend divided by 10%. Worth $50, right? And think about it logically. You're getting $5 a year in dividends. You're requiring a 10% rate of return. That means if you pay 50 every year, you're getting 10%. What happens if the company is growing their dividend by 3% every year? Well, how you would adjust for that, and again, watch my video, is to take the 10% less the 3%. You reduce your rate of return, required rate of return to 7% because you keep growing. In which case, now you take your $5, 5, there it is, 5, divided by the new rate, and I'm going to get a higher value because I'm growing my firm. And that represents 7142 represents the 7% rate of return on a $5 income every year. That's the growth rate. What happens? But the problem with using the Gordon growth model or the dividend discount model is companies don't always pay dividends. So that's an issue, right? You're kind of relying on the fact that a company is going to pay a dividend or that you're going to have steady cash flows. And what happens if a company hasn't paid a dividend today but has growth prospects? and you want to give a value to those growth prospects, right? Maybe companies don't pay anything. Maybe they're using all their cash building up these great products. Think about Amazon in the early years, or any company that starts to build. They have all these great growth prospects, but they're going to keep using their cash. Apple. Well, how do you value that if you can't assume a dividend? That's where the limitations of this dividend discount model is. Right? Because you have to make all these assumptions about the growth rate of future dividends, which is fine, but they are a lot of assumptions. You have to assume sometimes that they're going to pay a dividend. You could use a price earnings ratio, which is the value of the price of a stock versus its earnings. So if a company's earning $3 a share, and so one way we can value companies is using the price earnings ratio. Right there, you can get a little bit more of the growth rate. You could use the growth rate, and you could look at where the markets trade. Like for instance, right now, the average company has got a price earnings ratio of about 17. So let's say your company is like considered like average, or just as good as any of the other companies out there, and you're paying and you're earning $3 a share, and the price earnings ratio is 17. Well, then your company would be worth 17 times 3, which is 51. Or what we're really saying is a company is paying 17 times earnings. Investors are willing to pay 17 times earnings. And what does that really tell me? If I take 1 divided by, if I take 1 divided by 17, it's a 5.8% yield. Because if I'm paying 17 times for $1 of earnings, I'm getting a 5.8% cost of capital. Right? And so that's my cost of capital. The market's telling me that my cost of capital is 5.8%. So that's what they're paying for my equity. So that's how they determine, that's the required rate of return for my equity. So price earnings ratio is another way you go. Okay, so we did that. You got to look at economic and macro factors that might affect an investor's rate of return. You got to look at firm factors that could impact the growth rate. You got to look at a firm's investment opportunities. These are all things that affect the price earnings ratio. And the other problem with price earnings ratios is earnings are not always consistent. Some companies might report earnings with some losses from previous years. Some companies might adjust for those losses. You would think they would all be consistent. They're not. And that could be one of the issues. So if you're going to use a PE, you have to make sure that you know what you're using. You may have to adjust that. And I know investors out there that adjust the PEs when they invest their money. Preferred stock's another way to go. It's almost like borrowing money. The yield on the preferred stock is the dividend paid on the preferred stocks over the market's required yield. Finally, you could value your bonds by whatever the market wants for the yield to maturity, whatever the market is saying your bond should yield, 10%, 8%, 9%. Video again is in my YouTube. You could value your preferred stock by whatever the dividend is. You could value the common stock by the dividend discount model, or of course, the capital asset pricing. Okay, so I don't want to run out of time this morning, but let's go back here. For those of you at home, you can get a lot more information by going down. Here's weighted average cost of capital. It's in chapter 14. Some of the stuff that I went over today is in chapter 14, which is the weights of the debt you're using, the cost of debt, the weight of the cost of equity. Finally, in chapter 15, they have capital structure theory. And in chapter 15, you're going to notice they're going to go over the stuff that I went over in the beginning. Medigliani, capital irrelevance theory. Cash distributions are not affected by financial leverage. They talk about Yogi Berra's famous saying. He says, I'll take a pizza, I'm not that hungry, cut it into fours. 4s, 8s, it's the same thing. They talk about the violations of the assumptions, which I went over with you. Transaction costs are important. Firms can borrow more cheaply than individuals because of the capital, the debt shield. They talk about it. So they really go over it. And that there are bankruptcy and financial distress costs. If taxes were the only reason, the firm would simply use enough debt. You'd always use debt because you're getting the break. However, the downside of using debt financing quickly becomes apparent when the firm's debt obligations exceed its ability to generate cash. When this is the case, the firm will need to work out a deal with bankers and bondholders to restructure its debt. So what you get is finance distress costs. So it's not simply just taking on more debt. You start to get deadweight costs. You also get like what we call a debt overhang, which means firms may not even invest in new stuff because they're dealing with all this debt. Obviously, one of the ways you can get company to act most efficiently, like we talked about, is the idea that they could be taken over. Some lines of theory talk about just paying out all your cash flow. Like that's why the LBOs, the buyouts that you've seen over the last number of years have been very popular because they disgorge cash flow. Investors, the company doesn't have extra money laying around to invest in things like stadiums or putting their names on stadiums or buying planes. So investors just get their money back. So financial distress costs are a problem. The suppliers worry. Even there's studies that say like companies that sell durable goods like cars or appliances, they suffer too. Because if you know the company's in trouble, you may not want to buy their appliance or their car. Because you may feel the warranty won't be honored. Even that becomes an issue. Suppliers don't want to lend to you. We saw issues in the past where, you see some of these retailers like Macy's, when they were forced into bankruptcy because people who supplied them with shoes and pants and things that Macy's sold, they do not want to give it to them because they're afraid, hey, I might be out of business. That's a financial distress cost. Financial managers will say that another important factor that limits their use of debt financing is that debt financing severely limits their flexibility. For example, if firms A and B were to find themselves in a mild recession and also in need of funds to finance a new business opportunity, firm B would find it very difficult to borrow because it can barely pay the interest it owes on existing debt. Firm A, on the other hand, had some financial slack, which I talked about, and it has $50 in operating earnings that's not obligated for interest. In this case, firm B's owners may be unwilling to issue new shares, believing that in a depressed state of the economy, the firm's shares are undervalued. As a result, they may have to pass up a profitable investment opportunity. Firm A, on the other hand, will be able to finance the investment. It has more of the cash flows available to reinvest because it's not obligated to pay a dividend and because it has no existing debt. So you start to see where this idea of holding on pecking order, financial slack is really important. Interest expense is tax deductible. Debt is more likely than makes it more likely that a firm will experience financial distress. So we have this constant trade-off of the tax deductibility, but financial distress. So the trade-off theory says we trade these positive and negative factors. On the one hand, firms that have substantial amounts of taxable income can eliminate by taking on debt, and that face modest risks of incurring the cost of financial distress will tend to have higher debt ratios because they can handle it. On the other hand, firms that are not generating a lot of taxable income, and that will be subject to substantial costs. And one of the things that's helped over the years is the issuance of convertible securities, which is sort of hybrids, and they're debt, but they convert into equity. That's helped because it allows companies to raise capital, lower their cost of debt because they're giving an equity kicker, and have it hybrid. So they kind of blur the signal, the negative signal. And here's agency cost. If a manager who controls the firm's operations only owns small fractions of its shares, the self-interest will not always be the same as the interest of stockholders on the majority. When this is the case, the manager may make choices that are not in the shareholders' interest. It is sometimes possible to reduce these agency costs through the use of debt financing. For example, it is often argued that managers of firms that have high levels of cash flows tend to become complacent about controls over spending that cash and may engage in wasteful spending, such as buying expensive buildings and airplanes. Corporate executives may also invest in new lines of business that provide opportunities for themselves and their employees, but not for the firm. One way to limit these choices is to get managers to focus more narrowly on stockholder interest and the firm's debt obligations, thereby reducing the firm's discretionary control over cash flow. For example, in 2009, a financially distressed Citicorp canceled the delivery of a new jet. So you want to make sure that that you've dedicated these cash flows so managers don't make bad decisions. Stuart Myers was on the Mount Rushmore of this theory, suggested that because information issues arise when firms issue equity, as I talked about, they want to rely on their own internal source of financing or sell short-term debt. They don't want to issue equity until that's the last resort. This would be the pecking order. Convertible bonds I talked about, right? So the first thing is you want to use retained earnings. This doesn't send out any signal. You don't have to even deal with the fact that your shares are too low. You might send out a bad signal. You may have to borrow too high a rate. After that, you would do short-term debt. Then it would become longer-term debt. Then convertibles, and equity would be a last resort. Higher levels of debt can benefit a firm for two reasons. First, interest on the firm is tax deductible, where dividends are not. Second, the use of debt financing can sometimes help align the incentives of managers and those of shareholders. Higher levels of debt also increase the distress or bankruptcy costs, and that is a negative. So that's the trade-off. That's M&M. It doesn't matter. If you have no distress cost, then the blue line says we'll just keep adding on to debt. The debt ratio should go up, and that helps the value. The red concave line is that debt influences a firm's value and does create a negative scenario. At one point it's optimal, but then you're putting on too much debt. This is really good review. Okay, before we run out of time, I want to go over one other thing. You're going to be doing in a second project. So there's all stuff you could now incorporate into this project. All stuff you can incorporate. The last thing is they want you to learn how to use Mergent, which is a great idea. So you're going to pick a company and you're going to have to come up with the debt to equity ratio, the current ratio, the return on equity, put it in a spreadsheet, send it to me, or put it on an Excel document, a spreadsheet. So how are we going to do that? I've already called it up. This is you'll find this under okay. When you go into the Mergent online, you open it. And I put my accounting playlist. I also attach my spreadsheet. There's Investopedias on all the ratios. It's all there for you, plus my own plus my own videos on it. You have a lot of information here. Click on this to get to Mergent. You should go over all of this because you may use this for other things in your business program. Click on Mergent Online. Watch the video so you know how to use it. This is a great resource. School really provided you with a great resource. You also have Excel help. Tremendous. Okay. Excel basics, Excel for accounting, good stuff. Go back. APA, you got to do some stuff in APA. It's all here. I'm not going to go through the whole thing, but you should definitely spend time with this. But let's go now to what you have to do. So you got to go to Mergent. And you're going to call up Mergent Online by clicking on that. After you watch the videos, you're going to watch also the videos on the 3 ratios. And chapter 4 in the text, and I've called that up for you too. I think I kept it up here. So chapter 4 has everything on liquidity. So you have to go over that so you remember what to do. This is all in liquidity ratios, all the ratios, chapter. Go to 4.3 on everything on ratios. Go to my YouTube on ratios. Go to all the Investopedia stuff I sent you on ratios. You have a ton of information. Right? So there's no reason not to know what a ratio is. When you get here, then you're going to click in a company. So they ask for Apple. Let's do Apple. So there's Apple Computer. I put in the symbol. You just have to look up the symbol, write the company name in. Hit go. I put AAPL, which is a symbol. I could have put in Apple. You could put in IPM, whatever they ask you. There it is. So once you get to this page, and it's going to give you all your information, any stock that you're interested in, you should look up. Then go to company financials. And to do current ratio, it's current liabilities, current assets over current liabilities. Well, there's your current asset number. Going back to 2016. There's your current asset number. 106, 128, 131, 162. And there's your current liabilities. 42, 37, 32. They had no liabilities back then. They were just self-generating cash. So you could just work out the numbers. Since 2016, current assets were, so that'd be 100% because you were totally current assets. But then in a year like this, you have 131 over 116. So you would just do the math. 31 of 116, what's that ratio? Equals 131 over 116, 1.12. Obviously, you can't divide by 0, so I would just put NA, or you could just make a note. Okay. Then they ask for the other ratios they ask for. Current ratios, total debt to equity. So how do I find that? Well, if I go down here, got total assets, 321, 375, 365. I got total debt here, which is 78. So debt to equity will be 78 over 321. And I don't want to do your homework for you, but there it is. And where do you find a definition? You could do the return on equity on your own. Where you find these definitions, go back to the text, go to the videos, go to all this stuff we give you. See where the current ratio is assets, current assets over current liability. Okay? But the assets over liability, like I did. They give you an example. Can't divide by 0. So in the years if you use Apple in the years where Apple didn't have any current liabilities. It's just, I don't know what, you could just make a note, say, I couldn't divide by 0. These were the numbers, Professor. Then we want total debt to equity. Let's see if I can find that. Sales to total assets. It's liabilities, total assets. Just look it up. Read the chapters. Debt over equity. In which case we know Apple, we showed you 24%. Okay, so YouTube is your code word this week. Are there any questions? I covered everything. The last thing I wanted to just mention was your discussion. Let's get on that. Assume you're a new manager in the financial analysis department and are orienting a team of new college graduates to the world of capital budgeting. In your initial post, explain the uses of common capital budgeting tools. Explain what they are and how you use them in your daily tasks. Make sure to explain any financing terminology. But that's it. Stop sharing for a minute. Any questions? Any questions at all, Terry or Mary? And I appreciate you coming in today. Okay, great. Terry, you're from, I'm trying to remember. Where are you calling in from again? Oh, okay. All right, guys. Well, yeah, that's it. West Fargo. Great, terrific. Mary, where are you calling in from? Okay, Wisconsin. Packers fan? And you got the Bucks. The Bucks. Hey, the Bucks closed out last night. They won that series. They got a pretty good team, the Bucks. I mean, of course, we follow the Knicks down here, but they got a pretty good team. Oh, Dave, how are you, Dave?
Very well. Sorry I'm late. I just realized I got the time zone wrong.
Don't sweat it at all. You can just watch the video. I'm going to be posting it in a minute. It's all there. Just give me the video. I love that you guys come, but obviously we try to make this as user friendly as possible. So, where are you calling in from, Dave?
Chicago. I'm in the suburbs of Chicago.
Good. All right, guys. Have a pleasant rest of your Memorial Day weekend. Thank you for checking in, Dave. Thank you.